Good morning, afternoon, or evening, depending on where in the world you are watching. Welcome back to Afternoons with Aces, presented by Tom Simkiss and Lee Briggs. This is the first of several sessions that Lee and I will be presenting over the coming weeks and months in our cloud reporting series. Quick agenda on what we're going to cover today. We're going to discuss chart accounts. We have some best practices that we're going to cover, both from an Oracle point of view, meaning that's part of the Oracle documentation that you can get from docs.oracle.com. And we'll have some best practices that Lee and I have developed across our combined 40 years of Oracle implementation experience. We will discuss the concept of a thick ledger versus a thin ledger. And then we're going to finish off with some basic do's and don'ts in your chart of accounts naming. Lee, you want to do an introduction?
Absolutely, Tom. Thank you. My name is Lee Briggs. I've been working with the Oracle applications for the best part of 25 years. I've worked with EBS for the first 12 years of that, and for the last 13 years, pretty much since Oracle cloud has been available generally, I've been working with cloud. I am the Cloud ERP Team Director here at Creo, now an SMX company. I am an Oracle Ace. I got my Oracle Aceness in 2013. I started as an Ace Associate. I'm now an Ace Pro. I've been an Ace Pro for 8 years, I think. And I am the first Star Presenter of the Year award winner, awarded from OATUG. That was in 2014. Tom.
Thanks, Lee. My name is Thomas Simkiss. I am the Commercial and SLED Practice Director for Creo Consulting, now an SMX company. I've been with Creo since 2017. I have my Bachelor of Arts in Economics and Business Administration from Ursinus College, and I got my JD from the James A. Beasley School of Law of Temple University. I've been working with Oracle for the better part of 25 years. Started out as an end user when I was a staff accountant at a company called Real Treatment Centers, and they implemented Oracle, and I liked it so much I decided to get into consulting, and I've been doing it for the most part ever since. I'm also an Oracle Ace. I got my Ace in 2014, 1 year after Lee. As another side note, Lee and I have worked together through various companies for the better part of 22 years. So Lee is generally referred to in our small circle as the first Ace, and I am always referred to as the second Ace. I am also the OETUG Star Presenter of the Year award winner in 2017, again after Lee got his. So let's talk about chart accounts and some best practices. Lee, you want to take it away?
Absolutely. So when we start looking at the chart of accounts in cloud, how you start building it up, you really have two structures out there. You have chart of account structure. That really helps you establish an overall structure for the entire entity, whether you are local, whether you are global. The chart of account structure can be applied globally. So saying your first segment is going to be company, its second is going to be cost center, third is going to be natural account. And it's establishing that structure. Underneath the structure, associated with the structure, you can have multiple instances of that structure. So still keeping that same idea of company, cost center, natural account. But within our structure, in our chart of accounts instances, we can say, and this is the value set I'm going to use for company in the US, for cost center in Europe, for natural account in the UK. It's adhering to the same design, but you're having different value sets out there. And Tom's going to talk a little bit about value sets as we come along here. Now, within the general structure, we do have some required fields, segments we have out there. We're showing that under the segment labels. So out of the box, you get a primary balancing segment label, you get cost center, you get natural account, you get intercompany. You can actually create your own labels for the other value sets and segments you have in your chart, and we'll be talking about that in the later structure. You can also, in this area, and this is where the graphic that Oracle provides is a little bit loosey-goosey. You can talk about security. So putting security among your segments, you'd actually do that at the instance level. That is more associated with the value sets. So you can establish your security there, as well as getting your cross-validation rules, your account combinations. So that's what we're really looking at for your general account structure. Tom, do you want to talk a little bit more about some of the structure stuff?
Sure. So this slide is really mostly about Lee and Tom preferences. So even though you can use a value set across applications, that generally doesn't happen. It certainly has sometimes, but generally speaking, it doesn't. So our rules of thumb are any value set that you create, prefix it with your company short name or your implementation short name, right? So if you're doing an implementation for ABC company, your short name is probably going to be ABC. So we've got XXX there. We like to have ABC. We then like to see you prefix it with the module or the application that you're going to use this for. So in our case, we're talking about a general ledger chart of accounts segment value. So we've got XXX underscore GL. And then we like to put, what's the key flex field or what's the flex field that you're using this for. So in this case, it's COA or chart of accounts. Next, again, this is a preference that we have. We've got the country in there. So we've got US. Why do we do that? Well, if you're implementing a global chart of accounts, you might want to put GL or global in there. You might want to put something indicated. But a lot of times you have statutory accounts, you have local statutory accounts, and you have management accounts. You could also have accounts for various reasons, even if it's just a segment. So prefixing it with the company and also the country allows you to group these things together and know exactly what you're using. So if you do have to create a new structure instance or a new grouping, you can pick the right value sets without having to replicate them. And the final thing we have is just about general chart of accounts and what should be in there.
So one of the other things that I start looking at for the value set, the reason that we try to establish this naming structure out there, putting the module that owns this value set or the area it gives other lay people an idea of who they need to go and get something added. So I've seen some companies where we have a segment, a descriptive flex field on AP invoice or something using a value set that is used in the chart of accounts. You might want something added out there, and rather than just going to IT, if you have an idea of what that value set is, you know who you can go to. So yeah, it's not just an AP thing. Actually, this is owned by GL. Let me go to the GL folks and establish that, because there may be other things you need to do with it. It's not just adding a value. It's, well, in this case of general ledger, it's updating your hierarchies, publishing your hierarchies, doing all that kind of stuff where an IT person may not know all the processes you have to go through there. It's identifying that person who is super familiar with that area.
Thanks, Lee. So just to put a final point on this, we like to see this consistent. So if this value set where you're for fixed assets categories, the naming convention would be XXX underscore FA underscore major. Now something to note there, we didn't put the US for fixed assets. And why is that? That's because your category set for fixed assets is universal. So once you define your category set for fixed assets, that's going to be universal for your entire fixed assets implementation. And then finally on this slide, general best practice, plan for the future. So if you want to report by it, whatever it is, if you need a financial report by it, meaning a balance sheet, a P&L, whatever it is, it's got to be your chart of accounts. Product line, region, those types of things. If you want a financial report, please make sure you use it, plan ahead. We'll talk a little bit about financial reporting on some future sessions.
Yeah, now as one of the guiding principles that we have on our projects, and again, assuming this is an ERP implementation, first thing I want to look at when we're starting any of this stuff is show me your reporting. Because once you look at the reporting that you need, that helps to drive a lot of the conversations you have about general structure. People always say, I dump stuff to Excel and I do VLOOKUPs or adds or whatever to get my numbers. That's the kind of stuff you want to see. If I can see what your chart of accounts is, I can see the reports you need to look at. Maybe we should revisit how your chart of accounts is structured to make that reporting a whole lot easier.
Thanks, Lee. All right, we're going to talk a little bit about a thick ledger versus a thin ledger. We're not going to get super detailed on this topic. This topic alone could be a complete session. But we just want to talk about general concepts and things to consider so that as you're implementing your chart of accounts and you're talking to your systems integrator, you have an idea about what they're talking about if this concept comes up. Lee?
Yeah. So what we can see here, the main difference is shown in the name. I mean, it's some of this can be obvious, but for the non-accountant, maybe it's not. So a thick ledger is typically a heavy chart of accounts. There's lots of segments out there. There's probably a ton of segment values out there. So it's very detailed. It's getting down to the nitty-gritty, which makes your analysis from the general ledger slightly easier as you have everything right there. You can see exactly what it is. Now, if you have a thick ledger, typically means you're going to post all your transactions in detail. What do I mean by that? If I enter 100 AP invoices in a day and I post them in detail, I will see 100 entries hitting my AP liability account. When we get to the thin ledger, we'll talk about this in a little bit. For those same 100 transactions, you would see one line hitting your AP liability account for the total. So you're summing it up in the thin ledger. Thick ledger, you're getting all that detail out there. Now, with all that detail, that also means you're getting all your subledger information on that journal line. So of those 100 lines that are hitting AP liability, I can see that this line for $100 is for invoice 123. As opposed to the thin ledger where it's actually summarized. It is just a total. You can still get back to it. You've still got all drilled down. You've got analysis tools that are inbuilt in the system, account analysis tools to get you that information, but it's in the general ledger, in the thick ledger. Now, if you're doing everything as a thick ledger, your general ledger based reports become very heavy because you've got a ton of information that's getting summarized out there. So there's work to do there. The details there, but summarizing it is a slightly tougher proposition out there. So in our opinion, again, this is Lee and Tom. The thick ledger is typically an antiquated way of doing it. Let's go to the thin ledger. Thin ledger is a more minimal design. We are working with the assumption you've got the detail in the sub-ledgers to get this information. You can pass those attributes to EPM if you're using any of the planning modules, all that kind of stuff. But your analysis is coming from sub-ledger areas. So whether it's doing analysis in accounts payable, whether it's doing analysis through those account analysis reports, you're doing your analysis there. But that approach, really, you're looking for a willingness to use that rather than the general ledger. So there's a couple of different approaches out there. Our typical ideology is if you're doing an analysis with a lot of data and a lot of transactions, go for the thin ledger, have the summary information in the general ledger because you're probably doing your analysis in the subledgers. Tom, anything to add to that?
Yeah, I would say that our preference is for thin ledger, mostly because with all the tools you've got in Oracle Cloud, with the account monitor, with the ability to drill down the account analysis report, if you've got an account or a string of accounts that are of interest to you, and it's variance to budget, or you're trying to do the analysis, your first query is it of interest? If it's on budget, you're probably not going to look at it. So having all that detail in your general ledger journals report or in some of your account analysis reports isn't as meaningful. Whereas when you've got something that is of interest, again, if it's off budget, if it's off track, you can get to those reports very easily. It does require an ability to do a little drill down and again to run some different reports. But with that native ability with an OTBI to do those drill down reports, to get to that detail is relatively simple, and it's just really a preference. So with that, let's talk a little about some chart of accounts, do's and don'ts. Again, these are not from Oracle documentation. These are really about some things that Lee and I have come up with over the years. So we already talked about this, but it does bear repeating because it is something we feel pretty strongly about. The short name, we want that in front so that XXX, that's your company short name or implementation short name. We like to have the module or application for which this will be primarily used. And then, of course, the structure or the key flex flow to which it relates. So we've got XXX_GL_COA indicating this is for our company. It's for the general ledger and it relates to the chart of accounts. We really like these concept of related segments. Related segments are similar. If you got any EBS folks out there, they are similar to a dependent segment. It has long been a general don't do, and it's not supported in cloud to do dependent segments in cloud. But you can do this related segment structure, and it's very similar. And what that gives you is, unlike a cross-validation rule, in which case you'll get your full list of values, if you do a related segment whereby B is related to A, and if you pick 100 in A, you should only see value A, B, and C in B. Whereas if you pick value D in segment A, you'll see values X, Y, and Z. That's really cool functionality, and I get that request a lot. So we started to see some of these related segments. Now the drawback to related segments is you do have to define all those combinations. If you don't define those combinations, it doesn't work. So if you've got long lists of values, probably not something I'd recommend, but it's certainly something to consider. You can test it out in a demonstration or one of your test or dev environments if you like it.
So to kind of counteract that kind of idea, if you're looking for that same kind of functionality, you also have cross-validation rules. So cross-validation rule says, I'm not even going to try to remember the accounts that Tom was using in his little comment there, but you can start saying, hey, if you're coding something to a balance sheet account, you can't use a cost center, or you have to use cost center 000. If you're doing something to location that's in the US, then these cost centers are valid, these ones aren't. You can do those kind of rules, and those rules really are more dynamic. So it's not saying you cannot use this specific combination. It's saying these two segments together don't work. So your life gets a little bit easier there because you can actually foreplan this kind of stuff out there.
Thanks, Lee. A couple other things we like, again, we hit on these earlier, allow for growth. So again, if it needs to be in your financial reports, it needs to be in your financial statements. Please make sure you allow for growth using future segments. Lee and I prefer to have 2 future segments. We're not married to it. A lot of our clients only have one. But I will tell you, in the 20 plus years we've been doing this, we have had only one company use both future segments, in my experience. But I also have had one client, which was a client that neither Lee or I designed the chart of accounts. We came in at a later phase. They only had one future use segment, and they needed another segment. They ran out of segment values because their business changed. So, there really wasn't a clean way of doing it in the general ledger, short of doing a reimplementation, which we didn't want to do. So we wound up going to EPM, and we sent some information over to EPM, and we used attributes. So we did attribute-based reporting. So there's certainly options, but those future segments are very helpful, and you can always change the order that you present them. So if you decide at one point you want segment 1 to be segment 6, you can change that presentation without changing the actual order of the segments in your GLQ.
Now, I've had people say to us, again, we kind of typically go with 2 segments. Oh, do I have to key those in every time? Well, they have to be in the accounting string every time. But you can default a lot of this stuff in. I've had clients with 9 or 10 segments in their chart of accounts where 3 or 4 of them are defaulted in straight away. So you're just worried about those 6. And again, you can change those rules as you go through. So as you start to use this future 1 segment, you just start removing that default so someone has to key stuff in. So it's not putting a additional keying on the folks who are actually doing the data entry. It's more allowing that functionality in the future when you buy a chicken farm or something where you have to account for something in an entirely different way. You've got that flexibility out there.
A couple other things, logic in your chart of accounts. I like to have some logic, but not too much intelligence. What I have found after doing this as many years as I have, no matter how good you plan, logic will eventually break. You run out of structures, you run out of values. But I do like to have some logic. Examples that I usually have is if you've got a 3-segment company segment, typically speaking, I'll have my 1s and 2s as North America if I'm based in North America, or if I'm based in the United States. I will have my 3s as South America and Central America. I will have my 4s and 5 as EMEA. I'll have 6 and 7 as APAC. And then typically speaking, statutory or any types of adjustments like that, maybe in the 900s. One big adjustment or change that Lee and I have followed in recent years is when we've got our larger implementations, when you've got complex consolidation elimination requirements. I used to always use alphanumeric values for my adjusting entities, and I still use alphanumerics for all my parents, meaning my total parent value might be T, and my value for assets would be the word assets if my structure's long enough. But for my adjusting companies, I would use like an X or a Z or a Y, and if you don't have a lot of complex adjustments, that's certainly fine. But if you've got a lot of legal entities, and by a lot I really mean over 100, what I've started to do is, rather than creating adjustments or eliminations in my primary ledger, we're starting to create adjusting ledgers where you can book just adjusting journal entries. No other activity goes there, meaning it's a secondary ledger that you do not post journal entries to from your subledgers. You literally just use it for topside adjustments. And I've been booking my eliminations directly to the same company values, but in the adjusting ledger. So you're really using a ledger set concept to do your eliminations and reporting, and it's actually worked pretty well. A couple other things we like to see in your chart of accounts and your value sets. Do keep the values different, the lengths. So if you've got a company segment value that is 3 long, try not to have a cost center right next to it that's also 3, and then having a department center right next to that that's also 3. So you got 3 segments that are both 3 long. Just from an onboarding and a training perspective, people do tend to get confused. So we do like to try to break it up if at all possible. So we might have a value set where it begins with 3 segments, and then, or excuse me, 3 values, and then maybe one that's 2, and then 4, and then 3. Again, you just want to try to break up the length. And I guess the last thing that I would say is don't put too many segments in. I use this story a lot, but I had a client that we implemented in the early 90s that wanted a chart of accounts in Oracle that was 14 segments long. In the middle, 2 segments were alphanumeric, and they were both 14 characters long. And it was really a pain in the neck. For their interfaces, it wasn't a big deal because everything was already pre-coded. But when people had to book journal entries, they were really unhappy. So, you don't want to put too much intelligence and too much logic, but certainly having some is not a bad idea. Lee?
So the last item we've got on there is the intercompany segment, and this is one that is always a topic of discussion. It's something that Tom and I have had an interest in intercompany or intra-company for 15, 20 years or so. And it's trying to come up with the concept of using a segment for intercompany rather than having a ton of natural accounts to try and book your intercompany due from company A, company B, company C, or whatever. Just having that additional segment out there is just an easy way, and it's an easy way to maintain. It's an easy way to key where the intercompany goes, because your logic is the same. You've got values 1, 2, 3 in your company segment. In your intercompany segment, you have 0, 1, 2, 3. So everything will be coded. Everything you enter as a journal entry will be coded to intercompany 0, 0, 0. But when Oracle starts doing its intercompany accounting, generating those intercompany lines, it'll say, use that intercompany segment to say, yeah, this is due to company 2. This is due from company 1, kind of thing. Populating it immediately. But you don't have to build out the rules for that kind of thing. You just say, use this same natural account, use that intercompany segment. That's exactly what it's built for. It's something that is, I think it seems to be more of an Oracle type scenario out there, and some folks will really take some thinking, and they need to see it in action to get the idea of it. But it's certainly something to look at.
And we did have a question that popped up in the chat on the use of an intercompany segment. I will address that at the end when we get to the questions and answers section. All right, some value set do's and don'ts. Lee.
Yeah, so we mentioned briefly on the price slide. I don't think we talked about it. When you're creating your value sets out there, always allow for alphanumeric. We know that accountants, when they're keying stuff in, they're going to be keying on their 10 key. Everything is going to be a number. And for our child values, our detail values, the items, the segment values you're going to post to, makes all the sense in the world. But we always say use alphas because your parents, stuff that you're going to be building reports off, you're going to be building intercompany rules off, allocations off, or security off, all that kind of stuff. Use alphas for those. No one's ever going to key something to them, so you're not worried so much about that. You're also freeing up more child values, freeing up those numbers for folks to key accounts to because you're using alphas for your parents. So the example that the short example I show up here is for your all accounts, T for total, makes sense. Calling your total assets, asset, total liabilities, liabs, owners, equity, owners, something like that, where the name is kind of obvious already, but just from a hierarchy point of view, you get that kind of structure out there. We're really saying follow your trial balance when you start building these out. Mentioned earlier, you can default values in for segments that you're not worried so much about, not worried about at the moment. So your future segments, those 2 segments that Tom was talking about, you can default zeros in for those, or 9s, whatever you're using for not a cost center, not a location, whatever. You can default those in automatically to go through there. The other side of the do's for all this is setting those natural account qualifiers. It's one of the coolest things we have in cloud, certainly from an EBS point of view. You've got to have the account type. So is it an asset? Is it a liability? Trying to get that stuff right. Putting in whether this is a reconciling account. One of the coolest features you have out there is this is a reconciling type value. Everything out there is looking to say there's a debit going in here for 100 for transaction ABC. There's a credit for 100 for transaction ABC. They reconcile out. Really cool functionality to use in the appropriate setting. Putting the asset types out there. So the account types out there. So yes, this is a natural account and it is accounts payable. This is an account and it is a COGS account. That kind of stuff will really help from your reporting point of view. From your OTBI reporting point of view. I'm sorry, not from your financial reporting, but we'll touch on OTBI in one of these later sessions. As Tom said, logic in these values is great, but don't go overboard. The logic you always use for natural accounts, hopefully 1 is an asset, 2 is liability, 3 is owner's equity, 4 is revenue, 5, 6, 7 are expenses, that kind of thing. But don't go too nuts on no. But if the second digit is a 3, then it has to be something else. The logic works, but it's going to break down. You've got those parent accounts out there. That's going to probably help you out enough there. Certainly from a cloud point of view, duplicate value names, so duplicate descriptions is a no-no. In Essbase will start breaking down if you have duplicate descriptions out there. Again, it's not going to stop you doing anything. There is Oracle is going to force uniqueness in all those values, and if you have duplicate descriptions, then Oracle will put in the segment value and the description as a description. So you can't have 2 cash accounts. You can have 2 cash accounts, but it's not going to be cash and cash. It's going to be 1001 cash, 1002 cash. It's going to force that uniqueness out there. And the link you see on that document is current as of 23D, which is the release that is currently available, goes through that conversation out there. It also talks through descriptions to avoid. So there, Essbase does have some logic in there. So if you start calling an account not or, it'll freak out a little bit. But that note is a great note.
Okay, thanks, Lee. All right, key GL flex field segments. This is pretty much from the documentation. We won't spend a ton of time on this. Main one I want to highlight is cost center. You do not have to have cost center, but if you're going to put in assets and expenses, it is required. So if you're doing a phased implementation and assets and expenses is in the future, you might not set this now, not something we'd recommend. Again, you can always set your qualifier at a later date and rebuild your cube and rebuild your OTBI flex fields, but plan for the future and get it out of the way. So you have to have a balancing segment. That is the segment by which your trial balance will be balanced. That's where you're going to set your intercompany. You can have second and third balancing segments. That is new in cloud. That did not exist in EBS. I do believe that feature was available in PeopleSoft, one of the values of Fusion. Natural account segment is required. You cannot have a chart of accounts without that. That is where your cash and liabilities and all those other great things go. And then finally, the intercompany segment. We did get a question on that, as I said. I will address that question in the questions section shortly.
So one of the other items to think about for that cost center segment. So we said if you're using fixed assets uses cost centers for their reporting. It's one of the segments out there. Expenses use it as well. If you're looking at HR, one of the things you've got to start thinking about from an HCM, HR point of view, is having departments in HR, and there's functionality in financials to identify a cost center or department owner. Once you have that cost center segment out there, it is relating to an HR department. So it's certainly something to really focus on if HR is out there. I've seen folks who've said, I never just use location. Location is fine, and location is like New York or something. Kind of starts breaking down when HR is out there. So one of the key things on all your architecture sessions, as well as having the financial folks in there, you've got to have some of the other areas who are not really related to financials, just going in here to hear that kind of stuff.
Thanks, Lee. All right, last thing we have here is the general ledger to Essbase mapping. Lee, why don't you talk about this quickly as we wrap up?
Sure. So because Essbase is new to the EBS folks, these are some of the areas you'll start seeing in around Essbase. So around SmartView, around Financial Reporting Center, and it's trying to get what we talk about in General Ledger over to Essbase. So in General Ledger, we have a chart of account name. In Essbase, you actually get a separate cube for each of your chart of accounts out there. So that's where your cube name comes from. In your chart of accounts, you have segments. You have segment names, segment values, segment value descriptions. From an Essbase point of view, they're actually called dimensions. Essbase exists totally on dimensions, so you get all your chart of accounts. Segments will be dimensions out there. There are other dimensions for scenario, which we'll talk about in a little while, for period, for that kind of stuff out there. So you have those dimensions out there. You have, in General Ledger, the term we've got grabbed from this document is tree and tree versions. We can also call that account hierarchies and account hierarchy versions. We're talking about those in the latest in future sessions as well. They relate to the dimension member name. So within natural account, I will have multiple trees, multiple hierarchies out there, multiple tree versions, multiple hierarchy versions out there. They will all exist in that dimension name. Your primary ledger, your secondary ledger, your reporting your primary ledger, your secondary ledger, your reporting currencies, they all appear in your ledger dimension in Essbase. And you have ledger sets, so sets of ledgers you can report in Essbase across multiple ledgers within the same ledger set. They all exist in the ledger dimension. You have your accounting calendar periods, so both your periods, your quarters, and your years all exist in accounting period. And scenario name. This one is new to cloud. Scenario is at the, I guess, the smallest level, it is actual. All you're looking at is actual values. Oracle pre-populates that one already. If you're just using general ledger for budgeting, then you can create a budget scenario. You can create a forecast scenario. You can start doing reporting from actuals against budget, actuals against forecast, all those kind of variances. All those scenarios would exist in that scenario name, which is its own value set that's out there. Tom.
Sure. Last thing I would say with Essbase Mapping is try not to, actually not try, don't repeat segment names. So if you've got product in one dimension, don't have another one named product with a small case or anything like that. Essbase is very wonky and it gets unhappy very quickly. So if you have to have multiple charts of accounts and you want product in your US-based chart accounts and you want your product in the EMEA chart accounts, you're going to have to prefix it with some nomenclature. So you're going to have it called US_product and then maybe EMEA_product. You do want those dimension names different so that the cube will build and deploy properly. All right, so we did have one question, as I said, that came up in the chat a few minutes ago, and it is about intercompany. And I guess somebody was reading the documentation or I don't know, it's...
Were they stumping the chump?
They were trying to, but it's a great question. We get it a lot. It is, should you have the same value set for your company and intercompany segments? You only have to maintain one set of values. And the answer to that is an unmitigated no. You should not do that. And there's two reasons I have for it. One of them is strictly from the Oracle documentation, and one of them is just a personal opinion. And Oracle recommends you don't do it, mostly because security, as Lee said at the beginning of the session, is on the value set. So if you put security on the value set and you say you can't see company 100 or you can only see company 100, if you have the necessity to do an intercompany journal entry, it makes it a little bit difficult. It makes reporting difficult if you can't see your intercompany values. So you could potentially limit your balance sheet and your values that come back in reports. But from a practical standpoint, and this is again just kind of a Tom Simkiss bugaboo, in an intercompany segment, you're going to want to have a default value in there. Right? Because not everything's intercompany. So again, using the structure we've been talking about for most of the session, if you've got a three value set values, so your company values are 100, 200, 300, in your intercompany value set, you should have a default value of 000. Well, 000 is a default. That means there's no intercompany. I would not want a 000 value in my company value set because every journal entry has to go to a company. Could you do a cross-validation rule? Could you do an exclusion? The answer is yes, but I just don't like that. I don't like the ability to do it. And as I said, from a security standpoint, Oracle recommends that you don't do it. We'll see if there's any other questions that come up in the chart. There is a question that came up about reporting and how you want to set your qualifiers for reporting. And unfortunately, I hate to do this to you, but I'm going to ask you to tune into one of our future sessions to talk about reporting. This is the Cloud Reporting Series, Afternoons with Aces. My name is Tom Simkiss.
My name is Lee Briggs.
We appreciate your attendance today. Check back soon for the next session and have a great day.